Hey, what's up guys? Welcome to Accounting with Karim. And in this video, we're looking at the accounting cycle. And before we dive into this video today, and we have 8 steps, before we go from step 1 to step 8, I just want to make mention that in today's time, today's modern time, we're using a computerized accounting system to track our, economic activities within our businesses, right? So for demonstrative purposes, we will actually imagine that this was a manual accounting system. So yeah, let's dive in. And so step number 1, we have to analyze the transaction. So we have to look at what accounts are affected by this single transaction, and also look at the debits and credits. Like what account should we debit and what account should we credit. Step number 2, we have to journalize. So the next step is journalizing. So we have a journal, and for example, if I made a purchase for an equipment with cash, I have to within this specific journal, I have to say, okay, debit to equipment, the amount, credit to cash, the amount, a brief explanation of like why the purchase is, put some details, the documentation, like the invoice numbers and stuff like that, right? So that is step number 2. Step number 3, we have to post it to the general ledger. So the general ledger, the idea for the general ledger is, or the definition, the general ledger is a group of different accounts that are kept separately. So for example, the equipment account that we have, right? Only transactions that affect the equipment account will be posted to the equipment account. For cash, the same goes for cash. Only transactions that affect the cash account will be posted to the cash account, right? And so it keeps a running balance. So for example, money comes into the business, that will increase our cash. We're paying vendors for services that we use. So money goes out the business. We're using cash to pay those for those services, and so that will reduce our cash account. So it keeps the running balance at all times. Cash comes in, cash comes in, cash goes out, then it keeps the balance at all times. And then from step number 3 to step number 4, we have an adjusted trial balance. So the unadjusted trial balance is really because we have a timing difference in accounting. So every month we have to make adjusting entries to bridge the gap between that timing difference. And so then we have the adjusted trial balance. So from our adjusted trial balance, this is where we create our financial statement. So we create our income statement, the balance sheet, the cash flow statement, and the owner's equity statement. And so from step number 1 to step number 6, these are happening throughout the year. So on a monthly basis, we're actually, doing these steps, and these are very repetitive, right? These are happening each month. But from step number 7 to step number 8, these are happening on an annual basis. So these are annual occurrences. And so for step 7 is a closing entries, and 8, the final step, is a post-closing trial balance. And so the reason for closing entries, we have a distinction between the accounts that we have on the income statement and the accounts that we have on the balance sheet. So accounts on the income statement, like a revenue and our expenses accounts, those are temporary accounts. Our balance sheet accounts, those are permanent accounts. So the temporary accounts at the end of each fiscal year are closed into the retained earnings, right? So the temporary accounts, we start over from 0 the next year again. The permanent accounts, those are cumulative. They do not go back to 0. So that's the difference. This is why we have a post-closing trial balance at the end of each fiscal year. So these 2 steps right here. These are happening on a fiscal basis, annually. These from step 1 to 6, these are happening throughout the year on a monthly basis. So until next time, I see you guys in the next video. Cheers.